For years, the US dollar has been the backbone of global power. Oil was priced in it, trade was settled in it, nations stored it as insurance against crisis, but quietly, almost invisibly, that system is starting to crack. Across Asia, Africa, the Middle East, and even parts of Europe, countries are doing something once unthinkable. They're moving away from the dollar, not slowly, not symbolically, but faster than anyone expected. This isn't about a single country or a temporary protest. This is about a global shift in power, and the dollar may no longer be untouchable. For nearly 80 years, the US dollar has been more than just a currency. It has been a system of control. After World War II, the global economy lay in ruins. Europe was shattered. Asia was rebuilding. The United States, untouched by destruction and holding most of the world's gold, stepped into a position no nation had ever held before. At the Bretton Woods Conference in 1944, the rules of the modern financial system were written and the dollar sat at the center of it. Other currencies would be pegged to the dollar would be pegged to gold, and global trade would flow through US-controlled financial rails, even when the gold standard collapsed. In the 1970s, the dollar didn't fall. Instead, it evolved. Oil, arguably the most important commodity on Earth, was priced in dollars. Global banks cleared transactions through US institutions. International debt was issued in dollars. If a country wanted to trade with the world, it needed access to the dollar system. This created what economists call exorbitant privilege. The US could borrow cheaply, run massive deficits, print money in crises. And the world would absorb the shock because the world needed dollars. But that privilege came with something else: leverage. Over time, Washington realized that controlling the global financial plumbing meant it could punish rivals without firing a single shot. If a country crossed a political red line, it could be sanctioned, locked out of dollar clearing systems, cut off from international trade finance. At first, this power seemed unstoppable. Sanctions were used against Iran, then Russia, then Venezuela, then entire sectors of economies. Each time, the assumption was the same: no one could realistically escape the dollar. But something changed. When sanctions became routine instead of rare, countries began to notice a dangerous pattern. The dollar was no longer just a neutral medium of exchange, it was a geopolitical weapon, and that realization triggered a quiet panic. Imagine being a central banker in Asia, Africa, or the Middle East. Your country might not be sanctioned today, but what about tomorrow? What if political winds shift? What if alliances change? Suddenly, holding trillions in dollar reserves didn't feel like safety. It felt like exposure. This is where the story truly begins. In the background, away from headlines, governments started asking uncomfortable questions. Why should all global trade run through one country's currency? Why should foreign reserves be vulnerable to freezing? Why should economic sovereignty depend on Washington's approval? At first, the response was cautious. Bilateral trade deals began settling small portions of transactions in local currencies. China and Russia experimented with non-dollar energy payments. Regional banks discussed alternative settlement systems. Western observers largely dismissed it. These deals are tiny. The dollar still dominates. There's no real alternative. And technically, they were right at first. But history doesn't change overnight. It shifts incrementally. Then suddenly, by the early 2020s, three forces collided at once. First, sanctions overload. The sheer scale of financial restrictions, especially after the Russia-Ukraine war, shocked the global south. Even countries with no direct involvement saw how quickly reserves could become unusable. Second, China's rise as a trade superpower. China wasn't just exporting goods, it was importing commodities, financing infrastructure, and becoming the primary trading partner for dozens of countries. Settling everything in dollars increasingly felt unnecessary. Third, debt stress in developing economies. As US interest rates rose, dollar-denominated debt became more expensive. Countries asked a simple question: why borrow and trade in a currency we don't control? These pressures didn't create de-dollarization, but they accelerated it. Suddenly, moves that once seemed symbolic became structural. Central banks began reducing the share of dollars in their reserves, not eliminating it, but trimming exposure. Trade agreements expanded local currency settlement. Gold purchases surged as a neutral reserve asset. Most importantly, countries stopped talking about the dollar as permanent. That psychological shift matters more than statistics. Because reserve currencies don't fall when usage hits zero, they fall when confidence erodes, and confidence, once shaken, is hard to restore. What we're witnessing now is not the end of the dollar but the end of its unchallenged dominance, a slow fragmentation, a multipolar financial world, a system where countries ask, what happens if we don't need the dollar as much anymore? And that question, once unthinkable, is now being asked in capitals around the globe. Because this shift is no longer theoretical, it's happening in trade contracts, in central bank vaults, in infrastructure deals and commodity markets, and one region often overlooked is emerging as a decisive battleground in the post-dollar world: Africa. Let's start with the players driving the acceleration. China didn't wake up one morning and decide to abandon the dollar. It played a long game. For years, Beijing watched how financial sanctions were used not just against adversaries, but as a routine foreign policy tool, and it reached a clear conclusion: a system you don't control can be turned against you. So China built alternatives quietly. It expanded bilateral currency swap agreements with dozens of countries, allowing trade to be settled directly in yuan and local currencies. It developed its own payment infrastructure, and it encouraged trading partners to invoice goods outside the dollar, starting small, then scaling up. Energy was the breakthrough. Oil, gas, and strategic commodities began trading in non-dollar currencies, especially between China, Russia, the Middle East, and parts of Asia. The psychological barrier cracked. If oil doesn't have to be priced in dollars, what else doesn't? That question opened the door. At the same time, Russia's experience became a wake-up call for the world. When hundreds of billions in reserves were frozen almost overnight, even neutral countries took notice, because this wasn't about Russia, it was about precedent. If reserves could be immobilized based on geopolitics, then holding them carried political risk, and for countries that had spent decades building foreign exchange buffers, that was unacceptable. The result wasn't panic, it was rebalancing, gradual, measured, deliberate, and now, visible. But Africa's role in this story is especially important because it explains why this shift is accelerating faster than expected. For decades, African economies were plugged into Western-dominated financial systems by default. Trade invoiced in dollars, loans denominated in dollars, development financing structured through Western institutions. But that system came with constraints. Dollar exposure meant vulnerability to exchange rate swings, rising U.S. interest rates meant debt stress, and dollar clearing dependence meant limited autonomy. So when alternatives appeared, real alternatives, African policymakers paid attention. China didn't approach Africa offering ideology. It offered infrastructure, railways, ports, highways, power grids, industrial zones. These weren't theoretical partnerships, they were physical assets tied directly to trade flows, and increasingly, those flows didn't require the dollar at all. Trade between China and African countries expanded rapidly, and local currency settlements began appearing in bilateral deals. African central banks opened yuan clearing arrangements. Regional trade blocs explored reducing dollar dependence internally. This wasn't framed as dumping the dollar, it was framed as options and options. Change power dynamics? What makes Africa strategic is scale. The continent holds critical commodities: copper, cobalt, lithium, gold, agricultural output. As demand rises globally, whoever helps finance, extract, transport, and trade those resources shapes the settlement system around them, and China understands this better than anyone. While Western narratives focused on debt traps and warnings, China focused on logistics. When goods move along Chinese-built trail lines to Chinese-financed ports and are sold to Chinese markets, invoicing in yuan becomes practical, not political. That's the key difference. De-dollarization doesn't spread through speeches, it spreads through supply chains. And Africa is rapidly becoming one of the most important supply chain hubs of the 21st century. But China isn't alone. The Middle East has also begun recalibrating. Major energy producers long aligned with dollar-based oil markets have signaled openness to non-dollar settlements, not as a replacement but as an addition. Again, optionality. India is experimenting with rupee-based trade mechanisms. Brazil has expanded non-dollar trade agreements. Even traditional U.S. partners are quietly diversifying reserves. None of these moves individually end dollar dominance, but together they do something more dangerous for a reserve currency. They normalize alternatives. And once alternatives are normal, momentum takes over. Here's the part most people miss: the dollar doesn't lose relevance because countries hate it. It loses relevance because they no longer need it for everything. In a multipolar trade world, efficiency matters more than tradition. Settling trade in local currencies reduces costs, reduces exchange risk, reduces exposure to external shocks. And when sanctions loom in the background of global finance, political neutrality becomes an asset. This is why gold has surged in central bank purchases. Gold doesn't belong to any country. It can't be frozen digitally. It doesn't require permission. It's not replacing the dollar, but it's replacing trust gaps, and trust, once fractured, is slow to rebuild. What we're seeing now is the early phase of a fragmented financial order. Not one global currency but several regional anchors. Not one payment trail but multiple systems. Not one center but many nodes. That doesn't mean the US loses influence overnight, but it does mean leverage becomes harder to wield, because when sanctions push too hard, countries don't just comply, they adapt. And adaptation compounds. The real danger for the dollar isn't collapse, it's irrelevance in key corridors: energy here, commodities there, regional trade elsewhere. By the time the shift becomes obvious in headlines, it's already too late to reverse, and that's why this is happening faster than expected, not because the dollar is weak, but because the world is learning how to function without depending on it exclusively.